Welcome to the Contrarian Investor Podcast. We give voice to those who challenge a prevailing sentiment in global financial markets. This podcast is for informational purposes only. Nothing on this podcast should be taken as investment advice. Guests were not compensated for their appearance, nor do they supply payment in order to appear. Individuals on this podcast may hold positions in the securities that are discussed. Listeners are urged to educate themselves and make their own decisions. This podcast episode may have ads and the occasional announcement. To listen without ads or announcements and take advantage of a host of other benefits, consider becoming a premium subscriber. Visit the website contrarian.supercast.tech. That's TECH for more information. Now, here's your host, Mr. Nathaniel E. Baker.
Anthony Todd of Aspect Capital, you're joining us from London in the UK, is that right?
That is absolutely correct. Very, very good to be here. Thank you.
Yeah, great to have you. And we're going to talk about trend following. And this is something that it's not a new investment strategy, but it is one that is timely in your view. But we should probably start off and talk about what trend following is and how it works. And you are in as good a position as anybody to discuss that for reasons that we'll get into later. But for now, maybe just tell us a little bit about trend following and how it's used.
I mean, the first point to make, Nathaniel, which is something you just alluded to, it's not a new investment strategy at all. It might be unfamiliar to many listeners, but actually it's one of the longest established alternative investment sectors with a track record of generating performance independent of stock and bond markets going back to the 1970s. Some commentators will actually say even significantly before that. Now, in terms of the trend following itself, it actually covers a range of different approaches. So it's always difficult to generalize, but I think there are some common features shared by many trend followers. If I can just highlight three of those. The first is that typically trend followers will follow a very disciplined, systematic approach. So a completely automated scientific approach with the aim of identifying trends or momentum in markets over periods ranging from a few days to maybe several months. Medium-term trend followers will typically be looking to try to identify trends or momentum over a period of, say, 2 to 3 months or longer. That would be our definition. That was very much tie in with Aspect's definition of medium-term trend following. The second element is that trend followers, again, typically are highly diversified in terms of their approach. So we'll be trying to identify trends or momentum across multiple liquid markets spanning long-term bonds, short-term rates, currencies, stock indices, but also harder to access markets such as energies, metals, agriculturals. And then the final element is the ability for trend followers to be able to capture momentum in markets, whether markets are rising or falling. So whether we're seeing positive momentum, positive trends in markets or declining markets. So you take all that together in aggregate, the fact that the approach is so broadly diversified, it's not dependent just on stocks and bonds. It's adaptive in terms of its approach. It follows the trends and is able to capitalize on rising markets as well as falling markets. It's actually no surprise that the returns are uncorrelated with stocks, uncorrelated with bonds, and uncorrelated with many other alternative investment styles.
And so the catalyst to buy or sell securities, I guess, is based on technical indicators, if I understand that correctly, or what kind of inputs goes into this?
I mean, the inputs, the input for trend following will be the price itself. And so if you like the hypothesis behind trend following is that it's crowd behavior. It's crowd behavior that actually drives trends in markets. Different participants will react at different speeds to new market information, and it's that cascading effect of different investors taking into account different information, different inputs over different time frames. It's that crowd behavior. It's that herd instinct which we see so often by markets. Market participants are driven more by emotion rather than hard facts, hard scientific data. And it's that emotional response, it's that herd instinct that drives the trends. So the price action we actually can see today is just very slightly, it's a tiny effect, tiny edge in the markets, will be slightly affected by what happened yesterday, by what happened last week, by what happened last month. And so the main indicator, the overwhelmingly the most important input into a trend following model is going to be price itself.
Okay. And so when does one decide that something is a trend that is worth following? Like what kind of makes that cutoff?
Yeah, I mean, looking at our approach in particular, we apply 8 different what we would call price filters. And when we can talk about a price filter, what we're referring to is a statistical approach, statistical analysis of price behavior, which will try to strip out the noise in the markets. All markets have a huge amount of kind of noise, in the price action. So we apply, as I mentioned, 8 different kind of price filters over 8 different timeframes, with the aim of actually kind of stripping out that noise and try to identify the underlying behavior, the underlying momentum in terms of the market. The fastest price filter that we'll apply will be looking for momentum over a period of, say, 1 week or longer. Our slowest trend following filter will be looking for kind of trends over a period of around 6 months or longer. In answer to your kind of question, so what will actually depend on whether we're actually kind of taking, say, a long position or a short position, it's the weighted sum of the signals from those 8 different price filters.
Okay, got it. So, but fundamentally, or theoretically at least, you touched on it, the idea is not to obsess so much about outside inputs and reversals, but to get on board when the market is clearly moving in one direction and then ride that, I'm assuming for a short term, right?
Well, as I mentioned earlier, actually for us in terms of medium-term trend following, our largest program is predominantly a medium-term trend following program. We're actually kind of trying to identify kind of trends over a period of 2 to 3 months or longer. Now, actually, we'll be holding our winning positions, our profitable positions, for longer than than the losing positions. So, in essence, what we're doing is actually kind of running our profits. We cut our losses. So actually, in terms of profitable positions, we'll be holding those typically for more than 2 to 3 months. And there's some interesting examples in the portfolio at the moment where we've actually held positions for well over a year.
Oh, really?
So, yeah. So when there's a sustained trend, a sustained momentum in a particular market, we can be kind of holding positions for multiple months.
Got it. Okay, that's interesting. Now, this all begs the question, and you touched on it at the top, the various markets that this works with. I'm assuming these are the more liquid, the better. What kind of so what markets do you trade, do you focus on, and more tellingly, where do you see the opportunity right now?
Yeah, I mean, actually, in terms of the markets we trade, the markets we trade are the world's most liquid, predominantly kind of futures markets, kind of forward markets, spanning 8 different sectors. So I mentioned earlier stock indices, long-term bonds, short-term rates, currencies, credit, energies, metals, agriculturals. So in terms of our largest kind of portfolio, we trade over 180 kind of different markets. And again, all the markets we're actually kind of trading very much kind of focus on trying to actually kind of identify those markets which are kind of highly kind of liquid. And again, it's one of the advantages, I think, of that trend following programs, is that not only their ability to be able to kind of generate diversifying returns, but the fact that the programs themselves are highly liquid. The majority of our programs, the majority of investments from our institutional investors actually have daily liquidity.
Sick of me yet? Become a premium subscriber and avoid all ads or interruptions. Other benefits as well. Visit contrarian.supercast.tech for more information.
So in terms of markets where you've been seeing opportunity, can you talk about that?
Now, I can happily highlight some kind of current opportunities, but I think it's also important to emphasize that the trend following itself, the position we take in any individual market is path dependent. So in terms of the positions we actually hold today, they will evolve over time depending on the trend of the market. We are trend followers. We're not trying to, if you like, predict a trend. We're not trying to get ahead of a trend. We're actually kind of following the trend in the market. So in terms of the positions we're holding today, they may well be very different from the positions we will be holding in a few weeks' time.
Right.
But just to kind of highlight a couple of the specific examples, in the fixed income markets, in kind of long-term bonds, really, again, it should be no surprise to listeners, given the price action we've seen over the course of the last kind of few months, that overall in kind of fixed income, we're running a material kind of short position. To highlight a particular market, if you look at kind of 10-year US bonds, we're running a kind of short position there. That short position, we've been consistently short of kind of US bonds now for many, many, many months, for the majority of kind of last year. And again, I think it's one of the advantages of a trend following approach. Our positions are very intuitive. If you look across all the markets we trade, in spite of the fact we're trading, I'd say, close to kind of 200 kind of different markets, the positions we take in each individual market are highly intuitive. If you take a completely different example, highlighting one of the harder to access markets, which can provide valuable diversification, one of our more profitable positions actually so far this year has been a long position in the sugar market. Now, so agriculturals represent an important part of what we do. They can provide very valuable diversification by comparison with kind of stock markets, bond markets, kind of currency markets. Typically, those opportunities in the agricultural markets, they're very difficult for investors to secure access to. It represents a small but important part of the portfolio. And what we've actually kind of seen this year is there been supply disruptions, particularly coming out of the Indian kind of sugar market. That's actually kind of driven markets substantially kind of higher, for the majority of kind of this year. So that's been another significant component in terms of our performance so far this year.
Very interesting. And these have, as you mentioned, been obviously very profitable trades. I know nothing about the sugar prices, but I know that bonds have come down quite a bit, for several years now. Well, or at least since the Fed started tightening. But you have conviction in further upside for both of these right now?
Well, we have, in terms of the size of position that we hold in the kind of fixed income markets, that is, it's a reasonably kind of high conviction position. But again, that situation can turn very quickly. And a good example would be the Silicon Valley banking crisis, actually come during the course of the middle of March. So suddenly there was a very rapid kind of shift in terms of risk appetite. In the markets, we suddenly went from to an environment where investors were highly kind of risk averse, scaling back their positions in stock markets, flight to safety into kind of fixed income markets, and very quickly across our fixed income holdings, as a result of the kind of combination of, first of all, our faster price filters responding very quickly, but also that risk, if you like, that risk overlay I mentioned earlier, which is very sensitive to short-term kind of changes in risk in an individual market. In a number of our fixed income positions, we went from a very significant short position to flat. So that can happen. That happened actually over the course of a few days. Now, as the fallout from the Silicon Valley kind of bank, as market conditions ameliorated, we actually kind of started building a short position again. And that's my point about how a kind of trend following kind of portfolio, it's adaptive, it's very agile, it's responsive to price action. And again, as I kind of highlighted during that crisis, that combination of our price filters and our volatility measures work together in tandem to exit a substantial part of our short fixed income position. But that's now actually been, our short position has actually kind of gradually kind of grown over the course of the last few weeks.
It's grown. Can you talk about what you would be looking for to reverse the trade again? Any kinds of,
Well, I mean, in terms of, what would, cause us to change, kind of change our position, it is again, those kind of two drivers. One, if we actually were to see, a shift in kind of price action, if we were to actually kind of see a significant rally, in kind of fixed income markets, that of course would actually kind of lead to, first of all, our fastest filters, then our medium filters, then our slowest filters to shift position. And then again, kind of come back to that that fast volatility, effectively kind of volatility curve filter, which again would respond to any kind of sharp changes in the risk of an individual market.
Yeah. I mean, you mentioned price action in bonds. As we record this here on Tuesday, July 11th, in the US bond market, at least, the last couple of days have seen a bit of a rally in bonds. Especially like you look at the 2-year yield, it was 5% at the start of the week, and now it's 4.88, 4.89 as we record this. But that's not enough.
No, I mean, there's some very slightly kind of softer data that's actually kind of come out over the course of the last 24 hours. You're absolutely right. A move like that over a small number of days, we'll have picked that up in terms of our measures of risk. So that will probably have led to a slight kind of decrease in our position. The fact that move's actually happened over a few days, that would have affected our very fastest price filter as well. But that's just one out of 8 filters. So it might have actually just kind of faded our position very slightly. It won't have been sufficient to have turned the position around.
Sure. It's an interesting philosophical discussion here around investing. And obviously the topic of this podcast is contrarian investing, which has a bit of a different approach than what you're doing. The contrarian approach is to see something that is to basically take the opposite direction from markets. And you run with the market, which, is kind of like the anathema to contrarian investing. But then from that perspective, maybe that is contrarian. So, but you do find that obviously you've been doing this for a long time. You find that the signal is powerful. The price action is powerful enough to take advantage of.
I think it's a really interesting area to come discuss, because you're right that actually, our approach is very much to go with the momentum, to go with the investor flows, to go with the trends of the markets. So you could see us as being far from contrarian. But I think what's interesting here is actually, although we go with the momentum, the returns we generate are contrarian, are deeply contrarian. So if you look, go back in history, I mentioned over the very long term, trend following has this long-term track record of generating performance, which is uncorrelated with stocks, it's uncorrelated with bonds, but it's also been able to kind of generate very strong positive returns during protracted market crises. So if you look at periods such as 2000, 2003, the end of the technology kind of bubble, if you look at the global financial crisis in 2008, you look at the inflationary crisis we actually saw last year. So we see those kind of protracted kind of crises, significant kind of multi-month declines in kind of stock markets, potentially kind of rallies in kind of fixed income markets, not last year, rises in commodity markets. Those multi-month kind of trends provide significant opportunities for a kind of trend following approach. So trend following was able to generate significant positive returns during that whole period, 2000 to 2003, and again during the course of 2008. So I would say our return stream is very much non-contrarian. It's over the long term, the correlation with stocks and bonds is 0, but it has this unusual property of being able to actually generate strong positive returns in periods of protracted declines in stocks or bonds.
Mm-hmm. Interesting. All right. Anthony Todd of Aspect Capital, I want to take a short break and come back and ask you some more questions about your career and some other things, but we'll first take a quick break. If you are a premium subscriber, you do not get the break. Do not touch the dial. We'll be right back. In fact, we already are. And to become a premium subscriber, you can visit the website contrarianpod.substack.com and sign up.
We hope you're enjoying this episode of the Contrarian Investor Podcast, where we give voice to those who challenge a prevailing narrative in global financial markets. Consider becoming a premium subscriber. For $9 a month or less, premium subscribers receive a number of benefits. Podcasts are posted immediately after they're recorded. Transcripts are made available within 24 hours. Premium subscribers get direct access to the host And of course, there are no ads or interruptions. Visit contrarian.supercast.tech for more information.
By the way, you don't need the .tech suffix to get to that website. .com will do the trick. And we also have a Substack that where you can sign up for the same prices, same benefits, same details. contrarianpod.substack.com. So if you already have a Substack account and use it, or have the app and use that, that's probably the best way to go. So contrarian.supercast.com or contrarianpod.substack.com. Whole bunch of benefits, including, of course, getting this episode up to a week early without ads or annoying announcements. And you also get the daily Contrarian briefing and podcast that is released every market day morning at 7 a.m. This is a contrarian take on the events of the day ahead and what is likely to move markets, such as economic data releases, earnings, and other things. It is really good, and that is completely unbiased, of course. So check that out, contrarianpod.substack.com or contrarian.supercast.tech. Now on with the show. All right, welcome back, everybody. Here with Anthony Todd of Aspect Capital. Anthony, this is the segment of the show where we ask our guests to tell us about themselves professionally and how they came to investing in the first place, how they came to their current station in their career. And I mentioned at the top, you've had quite a pretty long and illustrious career already. So take us back and tell us about, your origin story, if you will, and anything else to take us up to the present day.
Yeah, I mean, happily, Nathaniel. So, I mean, actually, the background and the long kind of back history in terms of how I kind of ended up co-founding Aspect back in 1997 was I was very lucky enough to have read physics at university with Michael Adam and with Marty Lewick. And now Michael Adam and Marty Lewick went straight out of university, left university, and immediately actually went into Michael Adams' father's business. And Michael Adams' father actually during the 1970s had been running by hand a series of medium-term trend-following models on liquid kind of commodity markets. So I mentioned right at the very start of this kind of podcast how the medium-term trend-following sector has a track record going back to the 1970s. There are still a number of managers around today who can point to their origins in the 1970s. Michael Adams' father, again, was one of the very early kind of pioneers of this kind of trend-following approach. Mike Adam and Marty Lewick left university, joined Michael Adams' father's firm, and took that approach, built a remarkable kind of piece of, kind of technology to enable them to automate the trading systems, to enable them to actually research other kind of trading models, to expand the range of models, to expand the range of markets, expand the range of kind of trading frequencies. And that business was the origins of the AHL business, which of course is one of the most successful kind of quant managers today. Meanwhile, so that was the kind of common link, physics with Mike Adam and Marty Lewick. I left uni and went into the kind of fixed income markets. Joined a stockbroking company called Phillips and Drew that was then taken over by UBS. And in my time at UBS, I became absolutely kind of fascinated by the potential for applying a systematic scientific approach to trading the markets. I was surrounded by a whole range of traders at UBS, and it was clear that the most successful traders over the long term were those who actually ran a highly scientific, highly disciplined approach, not necessarily automated, but a very kind of rigorous approach in terms of the strategy they're applying and the risk management kind of techniques that they implemented. So I was very kind of fortunate that, as I said, meanwhile, Mike, Marcy, and then of course kind of joined by David Harding in 1987. They'd built a highly kind of successful business by that stage, and in 1992. I was fortunate enough to be able to actually kind of join AHL. At that point, AHL had around 20 people, in the firm, around 200 million under management. and I worked there. Absolutely kind of love working at AHL, from 1992 to 1997, and then spun out with Marty Lewick and with Eugene Lambert, who was head of trading system development at AHL, and co-founded Aspect.
And at no point did you think that maybe this isn't the correct way of the most profitable way of trading, that there was other things that you should consider? Did you ever lose your faith at any point?
Over the course of the last 25 years? No, not at all. I mean, absolutely not at all. I mean, I think, looking over the course of the last kind of 25 years, and again, we can actually kind of back test, our models. It's one of the advantages of a systematic approach, that we're able to kind of take our approach and apply it over the last 30 years, 40 years, kind of 50 years of data. And so we can actually kind of see that over a wide range of kind of different market environments. I mean, people are looking at the moment about whether we're going to experience over the coming months and years, are we going to see a soft landing, a hard landing, or no landing in terms of the global economy? We can actually take our approach and back test it over a range of different market environments. And I think it's one of the great advantages of that trend following approach. It's highly kind of robust over a broad range of kind of different market environments. And that, I think, has very much helped our conviction in the durability of this strategy. Now, it does go through, as with any investment approach, it can go through challenging periods. And so for medium-term trend following, times when markets are range bound, that's a challenging market environment, because our trend following models, those 8 filters I mentioned, are constantly hunting for trends which just don't materialize. The other kind of difficult market environment is when there are very sharp inflection points against the prevailing trend. A good example of that is what we saw earlier in March, this year. So over the 25 years that that we've been running kind of trend following programs at Aspect, we've certainly seen some kind of challenging years. We've seen some kind of challenging periods. But overall, I mean, our approach has been very much one of retain that disciplined approach, avoid style drift at all costs, remain disciplined, remain kind of scientific, continue to invest in research, continue to refine the models, but stay true to the original premise. And I think it's something we've seen, Nathaniel, over the course, I mean, particularly during the course of the last decade, where during the period 2009 through 2019, there were a number of actually kind of quite challenging, years during that period. And we know that a number of our competitors did actually exhibit style drift. They shifted away from that medium-term trend following approach. And it was our conviction in the durability of the strategy that meant we just retain that very consistent approach. We continue to innovate. We continue to refine our models. We continue to add new models. But at the same time, we retain that style consistency.
Perfect lead into the next question, which is your thoughts on AI. And you mentioned a systematic approach. Have you used or made use of any AI or AI type of tools yet? Do you see any promise in that as it affects your investing approach?
Yeah, I mean, we see, so, in terms of AI or AI-related approach, we have a material investment in machine learning. We have a kind of team that's been building, developing, running the machine learning models for a number of years now. They have generated very interesting, very attractive, diversifying returns from pure trend following. So we see AI and AI-related approaches as providing potentially a very strong, very interesting, diversifying area of research for us. But again, we look at the area as unlocking significant opportunities for us. But we can also kind of see that we have to kind of handle the area with care. I mentioned earlier, Nathaniel, that I think one of the great advantages of a trend following approach is the positions we take in across every market are completely intuitive. And it's that intuition, or it's that intuitive approach and that level of transparency which investors get, which I think is of great appeal. And that's why, in terms of the application of AI type techniques, I think it's very, very important that, again, any research we do is hypothesis led. It's important to actually have a hypothesis about what is the market effect we're actually trying to capitalize on. That's very different from just throwing a huge amount of data, at a set of kind of AI models and trusting the result. Because for us, it's very important that everything we do in research is totally kind of hypothesis led. So we can actually kind of understand still with our machine learning models why we're actually kind of taking any position we are in any of the markets we're trading. Mm-hmm. So absolutely, we're very, very excited, very kind of positive about those kind of techniques. We use them extensively.
Cool. Are there any areas of the market that you think AI that trend following doesn't work? Obviously, the more illiquid ones, I think, would be non-starters for obvious reasons. Anything else?
Yeah, I mean, where markets are not able to actually freely move. So if there are constraints, in markets where there is strong kind of central bank, intervention in the market, that actually limits the ability for crowd behavior to actually drive underlying trends. So that can be an issue for us. Liquidity you mentioned earlier, that to us is again a kind of key concern. There can be markets which are if you like, fringe markets, markets which have actually just been launched, which might exhibit very interesting kind of trends, but where the liquidity is either kind of episodic, it's unreliable, or it's just insufficient. So those are kind of two areas where we'd actually kind of see that we actually have to kind of tread very carefully. Where our focus is on deep liquid markets, and always our kind of focus is on markets which are, if you like, freely floating.
Mm-hmm. One area that you haven't talked about, which you may not even follow very closely, but you would think that it does kind of tick all the boxes, is cryptos, specifically maybe the more liquid ones like Bitcoin and Ether. Have you looked at that at all, or not so much?
No, we do. Actually, in one of our programs, we trade Bitcoin and Ether futures, not the underlying kind of cash markets. So, again, consistent with what I was just mentioning, we waited what we thought was a realistic amount of time to actually kind of see the markets mature somewhat, to actually kind of see that there was sufficient kind of liquidity there. We wanted to actually kind of trade the futures markets as opposed to the underlying cash markets. So it's important for us that the futures markets, did open up and there was sufficient liquidity there. So yes, those are kind of two markets that we do trade. We have relatively small, exposure to them, but they do represent, a part of our alternative markets program.
Mm-hmm. And anything you're picking up there in terms of momentum right now?
In those markets, so both those markets we are long. Again, unsurprisingly, given the run up, in price over the course, since the beginning of the year. So we have long positions in both those markets, but of course the level of volatility in both those markets is significant. Yeah. We're also just aware, although there is reasonable liquidity there, the size of positions, the risk allocation we can take to the markets is cautious, is relatively contained, because of potential liquidity constraints. The volatility is high, so in terms of the net position we're actually taking the markets, it's relatively contained.
Mm-hmm. Very interesting. All right, Anthony, Todd, this has been a really interesting conversation. In closing, maybe if you can tell our listeners how to find out more about you, be it websites or social media or anything like that. I'll also include those in the show notes so people can click on them.
Yep. I mean, in terms of our website, at www.aspectcapital.com, and then you'll also find us on LinkedIn, as well. So both of those, we try to keep investors very much, up to date with progress in the company, developments in the company. So please do take a look.
Cool. Not Twitter though, huh?
We're not on Twitter. We're not on Twitter. Something we thought about, but
probably smart. Probably smart. Okay, wonderful. Great, a wonderful conversation, Anthony. Thank you so much for coming on to the Contrarian Investor Podcast today and share your insights with us. We hope you all enjoyed it. I certainly did. And with that, we look forward to speaking to you all again next time. See you then. Bye.
Thank you for listening to the Contrarian Investor Podcast. We hope you enjoyed this episode. To subscribe to this podcast, simply open your favorite podcast software and search for Contrarian Investor. Follow us on social media by searching for Contrarian Investor on Twitter and Instagram. Send us your thoughts on feedback@contrarianpod.com. We look forward to speaking to you again next time.